Welcome back, Advanced Vita volunteers. This is the final lesson for our advanced topic series. So you have made it to the end. Congratulations. In this lesson, we're going to be covering the premium tax credit, which is a refundable credit associated with healthcare. And the way that this credit came about was through the Affordable Care Act. If you remember, way back in 2010, they signed in the Affordable Care Act. It's also referred to as the ACA or sometimes Obamacare. And the goal of that act was to improve health insurance availability and quality. And so insurers were prohibited from denying coverage or charging higher premiums for pre-existing conditions. So kind of the three prongs of this act to expand the availability of health insurance was through Medicaid programs, through the health insurance marketplace, which was a new thing, and through employer-sponsored coverage. So along with the marketplace, there was this premium tax credit that was enacted. And basically for families with incomes between 100% of the federal poverty line and 400% of the federal poverty line who didn't have health care coverage through some other sponsored place like their employer or through a state program or a government program, they would be able to go onto the marketplace and purchase a plan and get this premium tax credit to help make their insurance premiums affordable. So the idea was that for families who were less than 100% of the federal poverty line, they would be getting their health insurance through Medicaid or CHIP in Washington State. That's Washington Apple Insurance. And then for families over 400% of the federal poverty line, they would be able to get health insurance either through their employers or on their own, or even through the marketplace, but they just would no longer qualify for that premium tax credit. Now in 2021 and 2022, we did have some changes related to a lot of the COVID regulations. So at this point now, there's still that lower end where they're saying if people are qualifying for Medicaid, they won't be getting the premium tax credit. But the upper end, that 400% of the federal poverty line, is no longer a limit for claiming premium tax credit. And just to give you some context, the federal poverty line changes based on household and family size and based on where the taxpayer lives. There are some tables that you can find on the Health and Human Services website, so you can see that site name down there. Basically, from this chart, you can see kind of some ballpark figures for different family sizes and what does 100% of the federal poverty line mean and what does 400% of the federal poverty line mean. So there are some general qualifications to claim the premium tax credit. The taxpayer and any other individuals in their tax family, which we'll talk about in a few slides, they need to be enrolled in a qualified plan through the marketplace, and they need to not be eligible for any other minimum essential coverage. And we'll talk about what minimum essential coverage is in a minute too. They need to have paid their premiums by the due date of the return, and that's the unextended due date. So for instance, for our taxpayers coming in doing their 2021 returns, they need to be paid up on their premiums by the time they file. The filing deadline for this year is April 18th. So all 2021 premiums need to be paid by April 18th of 2022. Then if the taxpayer is married, they need to be filing a joint return with their spouse unless they are considered unmarried for the purpose of filing head of household. Or there are some other exceptions for certain victims of domestic abuse or spousal abandonment. So they would be able to claim the premium tax credit using the married filing separately status. But for all other married taxpayers, they need to be filing a joint return. So minimum essential coverage is coverage that is generally through an employer-sponsored health insurance plan, and that would be if it was considered affordable for the taxpayer. We won't need to determine that. That's something that the marketplace determines. Medicaid, or in Washington we call it Apple Health, is also considered minimum essential coverage. Medicare is coverage. CHIP, or Children's Health Insurance Plan, which also in Washington it falls under that Apple Health, or TRICARE for military members. So if our taxpayers qualify for any of these, then they would not be eligible for the premium tax credit. It doesn't matter if they aren't purchasing it, it's if they qualify to purchase it. Now, on the other side of it, if they are purchasing a health insurance plan, for instance, through their employer, even if it's considered unaffordable, if they are purchasing it, they are also not eligible for the premium tax credit. And it's important to note that this occurs, or this is figured on a monthly basis. So taxpayers who have or qualify for this coverage in the month of January will not be eligible for the premium tax credit in January. However, the next month might have a different eligibility. They might now be eligible for a premium tax credit because they lost their other minimum essential coverage. And that monthly amount or that monthly figuring means that if any day of the month they are eligible for premium tax credit, the whole month is eligible for premium tax credit. So if somebody, only has minimum essential coverage for a partial month, but they're eligible for the other part of the month, then that whole month is considered eligible. So back to some more general qualifications. So the taxpayer needs to be an applicable taxpayer. And what that means is that their household income needs to be at least 100% of the federal poverty line. Remember, if their income is less, then they should be getting Medicaid assistance. Or the taxpayer received or was approved to receive unemployment compensation for any week in 2021. So this is another new thing for 2021, where they are figuring that whatever the actual income of the taxpayer was, they're figuring that it counts for 133% of the federal poverty line. So it's just an expansion to allow, a little extra benefit and a little leeway during COVID times. Now, there are a couple of exceptions for the 100% of the federal poverty line rule. So those are for non-citizens who are lawfully present, and they have to be lawfully present, but they wouldn't be eligible for Medicaid due to their immigration status. So these are our permanent residents. Also, any taxpayer whom the marketplace determined was eligible for benefits, and benefits were received for one one or more months for a family member. So again, that's that marketplace determining their eligibility. And then the premium tax credit can be claimed for any member of the taxpayer's tax family. So the tax family includes the taxpayer, a spouse if they're filing jointly, and any dependents that are on the return. Sometimes, and we'll look at the advanced premium tax credit, the forms that people will provide us show people who are not on the return, and in those situations that return is going to be out of scope because there's going to be some sort of an allocation of the premium tax credit. So when we look at the forms that our taxpayers are bringing in, and again we'll look at those in a couple slides, then we're looking for people who are on the return. So as long as everybody is on the return, we'll be able to figure out the premium tax credit for that taxpayer. So in order to claim the premium tax credit for those family members or members of that tax family, they have to be enrolled in a qualified health plan, again offered through the marketplace. So this is figured on an individual level, right? So you might have some members of a family who qualify for health, like employer-sponsored health coverage, where other family members don't qualify for that, and so that family member is getting health insurance through the marketplace. So you only claim the credit for the family member who is getting health insurance through the marketplace, who is not eligible to receive any other minimum essential coverage. And again, as we talked about, they can't be eligible for any other minimum essential coverage. So that includes, if one spouse is working and they have health care coverage that could possibly extend to their spouse, even if they choose not to participate in that, they still are eligible for it. So they would not be able to get this premium tax credit. And again, this is all figured on a monthly basis. So another piece to this puzzle is that household income determines how much of this premium tax credit a taxpayer is going to qualify for. So the lower their income down to 100% of the federal poverty line, the greater amount of credit they'll be able to claim. As the income increases, then the amount of tax credit that the taxpayer could get becomes less and less. So the way that household income is figured is you take the adjusted gross income, and then you need to add in excluded foreign income, non-taxable Social Security, and tax-exempt interest. So for our clientele, we're probably more likely to see returns where it's adjusted gross income plus, say, non-taxable Social Security to get to the modified adjusted gross income, or the MAGI. So that MAGI is for the taxpayers, plus household income also includes the modified adjusted gross income of any dependents that are required to file. So in this case, you could have, a teenage child who is working. If they are less than $12,550 in earned income, they wouldn't be required to file unless they had some unearned income. So then if they're not required to file, you don't have to add in their income towards that household income amount. If they are required to file, then you do have to add in their income into the total household income, which again, as that household income increases, the available premium tax credit gets smaller and smaller. when our taxpayers come in, we are kind of first looking for this from the intake form. So this question 9 down in part 5 is asking if they have health insurance coverage through the marketplace or exchange, and then it says to provide Form 1095A. This, to be honest, is a question that can throw a lot of our taxpayers off. They don't understand what the marketplace was. Sometimes they've received a Form 1095B or C, and they think that that's what it's talking about. Sometimes our taxpayers got their Medicaid coverage through the same website as the exchange, or it appeared to them that that's where they were getting it. And sometimes our taxpayers don't realize that they've been getting premium tax credits because a social worker helped them get signed up, or a specialist helped them get signed up for their health coverage, and so they weren't really aware of all of the underpinnings. So it is important for us to be looking in particular at their answers to this question. A lot will mark unsure. So regardless of whether they have answered yes or no, you might want to ask some probing questions, ask them to provide you with that Form 1095A. Again, if you see that it's a B or a C, then that is not what this is talking about, and those do not need to be reported on the tax return. And I keep talking about the marketplace and without any kind of description of what that is. So here it is. In Washington State, Washington Health Plan Finder is our state's marketplace where people can go to sign up for insurance for their family. Again, there's a link right on the site to get to Apple Health, which is our state's Medicaid program. So if taxpayers have gone and signed up for Apple Health, that is not eligible for premium tax credit, and they wouldn't have received any advance on that tax credit. So so that's not something that will end up on the return. But some of our other taxpayers, some of our other clients may have come here and signed up on the marketplace, and they may have opted to receive some of this premium tax credit in advance towards the cost of their monthly insurance premiums. So when taxpayers make that choice to either receive some or all of this premium tax credit in advance to lower their premiums, or they may choose to not take any of it in advance and just take the credit when they file their return, there's going to be a form generated, a Form 1095A. And that form, it helps to reconcile any amounts that the taxpayers might have received in advance with the amounts that that they are able to qualify for once the year has ended. They will provide, when they sign up on the marketplace, they provide the marketplace with their estimated income, the information about what size their tax family is, and information about where they live. And the marketplace gives an estimate of what that premium tax credit is going to come out to be. And then if taxpayers choose to take that in advance, then at the end, we need to figure out if things ended up as they expected it to. For some of our taxpayers, this can land them in a little bit of hot water if they didn't update the information, and in previous years, especially where somebody was expecting to have a very low income and then suddenly their income was much higher, and they didn't adjust the amount that they were receiving for this credit in advance through the marketplace, they would have to repay some of it. So here's that Form 1095A, what it looks like. on part 1, it's just the recipient information, and then part 2 is that area for covered individuals. So that's where you're looking for individuals that are on the return. And if there are any individuals that are not on the return, that return is going to be out of scope for us, and we need to send them to a paid preparer. Then in part 3 is the coverage information. So you can see there's a list of rows with the months because each month is calculated separately. And then column A is the monthly enrollment premiums that they were paying. And then it compares what they were paying with a kind of base amount. They call it the second lowest cost silver plan premium. So there's a premium, an ideal premium that's the monthly premiums that the taxpayers are paying are comparing to. And then in column C is the monthly advance payment of the premium tax credit. So that's that advanced amount that they're getting in anticipation of what they will qualify for at the end of the year. So generally speaking, you'll see the same amounts in each row for each month of each column. When that's the case, the entry is just super easy, and you only have to enter line 33, the annual totals, into TaxSlayer. So it makes for a very quick entry, and that's the most common way that taxpayers are coming in with this form. Sometimes there are changes in the monthly amounts, in which case you would need to enter each month in separately. So when we are entering those that information from the 1095-A into TaxSlayer is going to generate this Form 8962 Premium Tax Credit form. Anyway, so you can see that there's some calculations that are figuring out whether based on AGI the taxpayer qualifies and for how much, and then there are some monthly figuring that it does, and then towards the bottom it looks at how much would need to be repaid, if any needs to be repaid, or if the taxpayers are able to claim some more premium tax credit, then how much do they get? And it's important to note this is a refundable credit, so even if our taxpayers have a tax liability of 0, if they qualify for this credit, they will be getting the credit amount back. Now there are some life events that happen during the year that can affect that premium tax credit, and sometimes unexpectedly, or our taxpayers didn't realize it was going to affect the premium tax credit, and so they forgot to update their information with the marketplace. And that is going to affect that reconciliation between what they received in advance and what they are qualified for at the end of the year. So things that can cause these changes are either increases or decreases in household income, which we brushed on a little bit before. If the taxpayers got married, if they get married during the year, again, that's going to cause an allocation, which sends that return out of scope for us. Divorce, the same deal. There's going to be some allocation, and so that will be out of scope. Birth or adoption of a child can affect the premium tax credit. There wouldn't necessarily be an allocation associated with that, so that would be in scope. Other changes to household composition, which may or may not cause allocation issues. Gaining or losing eligibility for sponsored health coverage. So this, might be common in a situation where somebody loses a job, or somebody becomes eligible for Medicare. Anytime there are those changes, that can affect the premium tax credit. And remember, again, this is on a monthly basis. So some months they might be qualifying for premium tax credit and other months not qualifying for premium tax credit. And change of address can affect that too. Again, the federal poverty line and their percentage of that federal poverty line changes based on location. The happy situations for this process are when the taxpayer got exactly what they were entitled to in advance, or if the taxpayer got less than they were entitled to in advance and will now be receiving the remaining credit on their return toward a hopefully higher refund, or at least less due. The uncomfortable situation is when the taxpayer received more in advance than they were entitled to, and now they need to pay some back. The silver lining for some of our taxpayers in this situation is that there is a limitation on how much will need to be repaid for taxpayers with a modified adjusted gross income below 400% of the federal poverty line. TaxSlayer does this calculation, but also the instructions for Form 8962 have a table that shows the upper limits, as you can see here. One strategy for taxpayers who are over the 400% threshold may be to agree to make an IRA contribution by the tax deadline that would entitle them to make an adjustment that brings their income back below the 400% threshold. If they choose to do this, remind them that because they are taking the adjustment now, they will need to be sure not to forget to actually contribute to their IRA. So the last thing we need to cover is scope. So if we have self-employed individuals who are taking the self-employed health coverage deduction and they are also allowed to take the premium tax credit, that's going to be out of scope for our program, and we'll need to send those taxpayers to a paid preparer for the year. Also, as we've talked about before, anytime there's an allocation where that 1095A shows people were covered under that plan, but those people aren't on the return, that's going to be out of scope for our program. Any individuals who are eligible for the health coverage tax credit and premium tax credit are not going to be part of our in scope for us. And then if you see code FF on Form W-2, box 12, in addition to Form 1095A, that's going to be out of scope. That would be where the taxpayer was eligible for a qualified small employer health reimbursement arrangement, but it was considered unaffordable. So that's out of scope. And the same with taxpayers who had an individual coverage health reimbursement arrangement. And I know that this sounds like a lot. Really, for the most part, our taxpayers who come in with these 1095As and got that advanced premium tax credit, typically you'll see the people who are on the return, or you'll see some of the people who are on the return, which is fine. Not everybody on the return had to be covered through this coverage. But typically we're not seeing a lot of other people on these plans where it would be out of scope. And typically you'll see a lot of forms come in where the amounts are the same for every month, and all you have to do is enter the totals. So it's really a much simpler arrangement to enter into TaxSlayer than all of these details that we've gone through. But it is important, again, to be able to do a little bit of explanation when in particular our taxpayers might have to repay some of this credit.